A pioneer in public finance since 1955, Ellers helps clients build outstanding places to live, work, learn, and play by delivering focused, fully integrated financial advisory services. We work with more than 1,500 local governments, schools, development authorities, and public agencies, placing their needs and best interests at the heart of everything we do. We help our clients navigate all facets of public finance, including financial management planning, economic development and redevelopment, debt issuance and management, investments and treasury management, and arbitrage consulting. At Ellers, we believe strong communities aren't simply the result of transactions. They're the result of people. We build strong, long-lasting client relationships, collaborating with your staff to complete projects and drive new initiatives forward. Building strong, vibrant, and sustainable communities. Together, it's what we do. For more information, call us at 1-800-552-1171 or visit ellers-inc.com.
Good morning, everyone. Thank you for joining us today for Ellers' virtual session to discuss tools of the trade, tax increment financing, and tax abatement. Before I introduce my coworker and we get started, I just have 3 quick housekeeping items to mention that will help ensure you have a good interactive experience with us. You'll notice in the upper right-hand corner of your screen, there are 2 icons. One is called Live Q&A, the other is Chat. As we move through today's presentation, if you have a question you'd like us to answer, simply open the Q&A tab, type your question in, and submit it. We've got our own Jessica Cook working behind the scenes for us today, and we will take a few breaks during our time together to answer the questions that you've submitted. You can also have conversations throughout the session with fellow attendees by opening the chat function. One thing to note, while you can submit any question anonymously, in the event we're not able to get to all of the questions today, we recommend you allow us to see your information. That will allow us to reach out to you directly with answers to discuss the issue further. Lastly, if at any point during our presentation you start to notice either video or audio lag, please go ahead, refresh your browser, and that should get you back on track. Now that we've covered these items, let's go ahead and get started. I'd like to introduce my colleague, Senior Municipal Advisor, Nick Anhut.
Thank you, Rebecca. Hello, everyone. Thanks for joining us today as we discuss the topic of tax increment financing and tax abatement. This session is designed to give you a basic overview of these tools and how you can apply them to your community as part of your overall economic development strategies. These strategies that you can use to create and retain jobs within your community, to redevelop some of those troubled, blighted areas in the cities or counties that you're working with, remediate contamination or polluted sites, construct affordable housing, increase your local tax base, and really provide a mechanism to help you create and manage a vibrant community. First and foremost, these are financing tools that you'll be able to utilize to help fill a gap in the private financing for these development and redevelopment projects. It is designed to encourage development that normally would not occur within the private marketplace, but for or without the public assistance and the ability to use these revenue streams to finance your projects. To give an example of a gap in a project, we've provided some numbers for you to look at, comparing a market rate site versus a affordable housing project that might constrict rents and therefore constrict the net operating income that can be used to pay for a mortgage or provide a private equity their return on investment. Next to the arrow, you can see that by restricting rents and lowering that net operating income, even though the project is identical, it has the same level of costs, it's able to obtain the same level of equity investment, that mortgage that's potentially going to be constricted by that lower income value creates a gap in the form of 1,290,000 that may need public assistance in order to bring that essential project forward within your community. These tools can be utilized in many different ways, and this slide illustrates some of those differences. Tax increment and tax abatement both can be applied in certain circumstances, but ultimately each project needs to qualify under the statutory framework within Minnesota statutes. First and foremost, redevelopment TIF can be utilized for substandard or obsolete buildings to redevelop a site, as well as renewal and renovation districts. Tax abatement can also service those needs. As far as affordable housing, housing TIF can be utilized, as well as one form of economic development TIF devoted towards workforce housing. Tax abatement as well can be utilized to assist an affordable housing project if it meets those qualifications as a public assistance. For job and tax base creation, economic development TIF districts can be utilized, as well as tax abatement. Tax abatement itself can also be used for business retention, for various types of commercial development, redevelopment, or even preservation. And then tax abatement also can be utilized to finance public facilities, parks, and infrastructure. As mentioned, both of these tools fall within the statutory framework, and your ability to utilize them needs to qualify under that framework. For tax increment financing, this is found in Chapter 469, Sections 174 through 1794. A working definition of this tool is the ability to capture and use most of the increase in local property tax revenues created from new development. So when we increase the value from new development or redevelopment, we're able to capture those revenues within a defined geographic area. We have to identify specific properties and parcels where that capture is going to occur, and for a defined period of time, those terms that you saw on the previous slide. One other nuance of this tool is it can be adopted by the local authority, whether that's a city or in certain circumstances, a county, without the approval of the other taxing jurisdictions. Tax abatement, on the other hand, has a slightly different definition, and we'll highlight those changes. It is found also within Chapter 469, but sections 1813 through 1815. It is also the ability to capture and utilize local property tax revenues, but potentially all of those revenues for an existing or improved value. It does also need to identify the specific properties that are to be abated, but it does not need the approval of one jurisdiction. It actually needs the approval of each of the school, county, or city in order to utilize those revenues. To get a basic understanding of how this tool can be applied to a project, you need to have an understanding of how property tax revenues are derived within our system. Each property carries a value. For purposes of these tools, it's important to understand the before and after effects. Before a TIF or abatement district is established, that property has what's called a base value. This value is contributing to your local property tax base, and it is contributing those local revenues that you need for your operations. When a tax increment financing district is established, those revenues still flow to those jurisdictions. It is still, that base value is still a part of your general tax base. For abatement, however, each jurisdiction has the choice of whether it wants to contribute that base value to the abatement district or to only capture that increased value. For purposes of our examples today, we will work with a property that has an original tax capacity, that tax capacity that's in place, that value in place at the onset of $1,729. When a new development comes forward, it's constructed, it is built, it increases in value, whether that's through brand new development on a vacant site or a substantial redevelopment of an already occupied site. That new value is the new total tax capacity that this property potentially can generate. For our discussion, that's $31,907 in this instance. It is that value that could potentially create an increase that can funnel revenues for this tool. Working from the bottom, that increase in value is able to generate a new revenue stream of $38,985. When we apply it, that increase from the base of $30,000 applied against the local levies, the local tax rates that are imposed on the property, generates a new revenue stream that can be utilized to help finance your project. I do want to point out that a property that is within a tax increment financing district or an abatement district does not pay any different taxes from any other like property within the community. It is this portion of their taxes that is captured and remitted separately to the TIF authority to help finance the project. It is not a rebate to the property owner directly. It creates a new revenue stream that a public entity can utilize to help finance the project. Instead of numbers, to illustrate this using a chart, hopefully something that's easier to understand, once an abatement or a tax increment financing district is established, we have already mentioned that the base tax capacity continues potentially to flow to each of the city, county, and school district. Those revenues that you are already relying on continue to funnel towards your operation. It's only when that new tax capacity is created, that increase in value shown here in the purple, over the life of the district, that potential revenue stream is captured and remitted to each jurisdiction for its use to help finance the project. As the project progresses, those TIF districts mature over time, working our way from left to right on the screen. Eventually, once their financial obligations have been satisfied, all of that potential tax capacity then turns over back to your general tax rolls and can be utilized to help sustain your operations within the community. That is ultimately the long-term goal of this strategy, is to increase your overall tax base and to help shape your community into the future. The next slide is going to highlight a difference within abatement. And particularly in this case, if one of the three jurisdictions decides to opt out and not contribute their tax capacity to help finance the project, in this case, we've identified a school district, their portion of the revenues are not contributed to help finance the project, and they would receive the immediate benefit of the increased value of the property to help funnel general revenues to help sustain their operations. It would only be captured within the county and city in this instance. But again, the same mechanism at the end of the life of the district, once all of the obligations are met, all of that value reverts back to the general tax rolls. At this point in time, I'd like to hand it over to Jessica to see if we need to address any questions that have come up in this discussion.
Thanks, Nick. We do have one question, and that has to do with how tax increment affects other taxing jurisdictions. Specifically, this person is asking about school districts and saying that in their city, people say that it hurts the school district. So Nick, maybe you can tell us a little bit about how that works. And the question talks about the but-for test, and that I thought with the but-for test, school districts would be made whole.
So first, to understand one aspect of school finance, the state is actually a contributing member towards making sure that every pupil within a school district is receiving adequate funding. So regardless of the property levels within the community, the state will contribute certain amounts of funds to help make sure that the school district can meet its operating budget needs. So in the instance of tax increment financing, what is happening is the base value continues to be captured. So the tax base that is there at the onset that the school district is already relying on is unchanged. When the TIF district project moves forward, that new value is created. That value is not included within the general property tax rolls. So they continue to receive the same amount of funding that they already had received. It's just the increase in value is now captured as increment and remitted back to the HRA or the city or the county that is administering this district. That funding to the school district remains unchanged for the majority of their revenue streams. One caveat is an operating referendum that is in place. Operating referendum taxes are not captured within TIF districts, and so the school district in that case would actually have a larger tax base when the project does move forward and would receive those revenues directly to sustain their operating referendum.
Thanks, Nick. That's all the questions we have right now.
So now we'll turn it over to Rebecca to continue our discussion on TIF and tax abatement.
Thank you, Nick, for setting the stage for our step in the case study. Now that we have an understanding or a basic understanding of the building blocks for both tax increment and tax abatement, we are going to use a case study to walk through how they could be used in real life and the process to establish both of these tools. We're going to assume a scenario where we have undeveloped land in our community with a developer proposing 49 units of rental housing. A portion of these are going to be affordable to the extent that they meet the requirements of a housing TIF district. In addition, the developer is going to apply for the 4D class rate. The project has a financing gap of $469,500. And we will also take note that currently the city does not have any abatement obligations. We look at the options of using either TIF or abatement to assist with this project. One thing that is important to remember is that generally abatement is a simpler tool to use and establish, and it is a significantly more flexible tool. However, TIF, we'll find out, also has some advantages on projects when they could be used to finance the gap. So starting out, as we compare TIF and abatement, we see that both ultimately end with a public hearing by the taxing jurisdiction. However, we'll note that on TIF, the process takes significantly longer. It could take 45 to 60 days, due in large part because of the notices that are part of the process and are required. Generally, tax increment has restrictions that the funds need to be spent within the TIF district or for sure within the larger project area, while a benefit of abatement is there are not project area requirements, so the funds can be spent anywhere within the boundaries of the community. One of the benefits of abatement is that while we typically see it structured very similar to tax increment, where we are capturing that increase in value, abatement does have that flexibility where, as Nick mentioned, you can abate existing taxes. In addition, you could abate a specific percent of the project or a specific dollar amount. So you really see that flexible structure with tax abatement, and tax increment does not have that flexibility. For those of you that have used tax increment, you know there are those annual reports that are required. A benefit of tax increment, there are those annual reports. A benefit of tax abatement, there are not annual reports that are needed. However, for either tax increment or tax abatement, you may be required to file business subsidy reports. One thing I do want to call out with tax increment and tax abatement is that with tax increment, there are not restrictions on the number of districts that you have in your community or the percent of your community that is in a TIF district. However, with tax abatement, there is a maximum that you can have. The annual total for tax abatement is the greater of 10% of the jurisdiction's net tax capacity or $200,000. And what I want to note with that is that is a annual and cumulative maximum. So if you have a new abatement project moving forward, you need to consider the existing abatement that is in place and look at it on an annual basis to make sure that you are within those limits of the greater of 200,000 or 10% of the tax capacity. Finally, as we look at some of the flexibility with tax abatement, is that there are very few restrictions on the end use. For example, if we are looking at setting up tax abatement for using affordable housing projects, you are not going to have the income limits and requirements that are there with tax increment. In addition, for redevelopment efforts, tax abatement does not require substandard findings or blight findings to qualify the area. Another benefit of tax abatement is the flexibility that you could use it for retail development if that is a goal and a need in your community where gap funding is needed. Also, something unique with tax abatement is that it can be used for those recreational facilities, which is a prohibited use under tax increment. So we do see communities using tax increment as a tool to help fund park improvements, swimming pools, ice arenas, trails, and the like. One item with tax abatement is that you may be able to issue general obligation bonds to help fund those park improvements or recreational improvements. And that is an option to avoid going through the referendum process to get those improvements completed. So as we think back to the housing case study and the scenario that we have presented, and also the tools that Nick walked us through as far as what may be available to help fund a financing gap, we see that really a housing tax increment district or tax abatement would be the two tools that are available to assist in this scenario. The next step as we consider those two tools is really, do we use TIF or should we be using abatement, since the project could qualify for either one? As we think through the pros and cons of each of those and those lists as we compare, TIF may take a little bit longer than abatement. It's a little more complicated process to set up. Tax increment, though, ultimately does produce the greater amount of assistance. And really, as we're looking between TIF and abatement, one of the driving factors as we try to determine which tool is most appropriate for the project is going to come down to what is the tool that is going to generate the assistance needed to fill the gap and be able to move the project forward. So in our example, we see that if we did go to the full 26-year term of a housing tax increment district, we could generate up to about $1 million. With tax abatement, if we assume that the city, county, and school all participated for their maximum term, it would generate about $560,000. However, if the city and county only participated, we would be very close to that, matching that gap of about $469,500. But if only the city participates in the tax abatement, we are going to be short because the city taxes are estimated to generate about $223,000 in assistance. So again, as we look at what tool is most reliable to fill that funding gap and allow that project to move forward, we are looking at establishing a housing tax increment financing district. So the first step when we get ready to establish a TIF district of any type is really to gather information. That includes putting together a project description for what we anticipate is going to happen or be developed, gathering the market value not only for the property as it stands today or that original, so we can determine that original base value, but also having discussions to determine what do we anticipate the completed value to be when this project is completed and done at some point in the future. Also gathering the tax rate information for the area. We need to estimate the fiscal impacts and how this proposed development could impact the police, fire, and public works departments in our community. And is the development going to create or trigger additional expenses that may impact, again, police, fire, and public works? And then finally, we need to put together a map for this proposed TIF district. And this map needs to show not only the boundaries of the TIF district or the area where that increment is going to be created, as shown in the orange in our example, but it also needs to show the boundaries of the project area and where a portion of that increment can be expended over the term of the district, as shown in the yellow area on this example. After we've gathered some of that basic information for the project, the next step is to move forward with putting together some cash flow scenarios and estimate what those taxes are going to be. You can see still using the tax capacity of 31,907 as Nick walked through earlier in the discussion. We are estimating total property taxes to be $48,249 after this project is constructed and assessed at full value. However, we need to note that even though the property tax payment will be over $48,000, there's some things, as Nick alluded to, that are excluded from tax increment and will not be able to be collected. With that, the first item is the statewide taxes. If this were a commercial development and they were paying state industrial property or commercial industrial property taxes, those cannot be captured by tax increment. In addition, if it is a development in the metro area or in the taconite area, we are not able to capture any fiscal disparities adjustments. Nick alluded to the market value taxes and following up to the discussion or the question about the schools being impacted. Many times those market value taxes are attached to a school referendum. And as Nick said, they are excluded from tax increment. Not only those taxes that are in place at the time the district is established, but if there are future referendums that increase that, none of that will be able to be captured through tax increment. And then finally, those base value taxes that continue to go to the city, the county, and the school district throughout the term of the tax increment district. So while the total property taxes are roughly $48,250, the amount of annual gross tax increment is closer to just under $39,000. So I recognize that there are a lot of numbers on this page, but if you look to the left-hand side of the screen, the numbers followed with that example that Nick walked us through, showing from the tax capacities times the tax rate and how we got to that annual gross tax increment of about $39,000. What I want to call your attention to are really two of the last numbers that are on our cash flows when we put them together. First of all, you will see that there is an administration column of 10%. With any tax increment district, the authority has the ability to retain up to 10% of the tax increment to reimburse themselves for administration of the district. This can include the staff time to make sure the district continues to move forward as intended. It could include time spent or people hired to assist with the annual reportings or any other administration that is needed for the district. The final number that we look to on the page is, in this case, the $469,488. And that is the amount, or the principal amount, that would be available or estimated to be available to fill the gap in this project's financing. So with that, in this scenario, the community would be able to issue a note for roughly $469,500 and be able to pay principal plus interest on that note over the term of the tax increment financing district. So now that we have the basic components of the information and preliminary cash flows put in place, the next step is to compile that into a tax increment financing plan. It is important to remember that this document ultimately is that it is a plan and it does not commit the final obligation for the district, but it puts the tool in place to eventually and ultimately enter into agreements and issue tax increment notes or other obligations related to the project. So the TIF plan includes that project description. We incorporate information on the parcels included in the district where the increment will be generated, along with that map showing the project area and the TIF district. The tax increment financing plan also sets the maximum budget for the TIF district. Again, it is a maximum. It does not create any obligation. It just sets the maximum you can have expend through tax increment. And then we incorporate that information on the fiscal impacts and what the impacts to the police, fire, and public works as a result of this development. We alluded to earlier that one of the differences between TIF and abatement is really the time needed to establish a TIF district. And in large part, that additional time is needed due to the notices that are required to complete the process. If we are establishing a housing or redevelopment TIF district, we are required to send a notice to the county commissioner that represents the area where the TIF district is, to let them be aware that this is being considered by the community. For any type of TIF district being established, there is a requirement to send the TIF plan along with that fiscal impact information to the county and the school district 30 days prior to the public hearing. While they do not get to ultimately vote on whether or not the TIF district moves forward, we do provide them that information and do ask them to provide any comments, participate in the public hearing, or provide any feedback they have on the proposed district. The final notice then is the public hearing notice that needs to be published in the local newspaper at least 10 days prior to the council's public hearing. As we wrap up this process for establishing the TIF, that final step is the public hearing that is held by the city council, regardless of who the TIF authority is. So even if you have an EDA or HRA as the authority, it will be the city council that holds the public hearing, and after that hearing considers a resolution to adopt the TIF plan. That resolution does need to contain 4 findings. And so after the hearing, the council needs to consider, does the proposed TIF district meet the type of, or follow the requirements outlined in statute for the type of district being established. The council needs to make that but-for finding that without the assistance through the tax increment, this project would not move forward. There is a finding that the TIF district conforms to the general development plan and goals for the community. And then finally, that the TIF plan and district afford maximum opportunity for the city's development needs. With that high-level overview of TIF and the process to establish the district, I'm going to turn this back over to Nick, and he's going to talk about the abatement process.
Thank you, Rebecca. Let's switch gears for a moment, and let's imagine that our original housing project is 100% market rate and therefore has a much smaller gap in financing, perhaps due to some contamination on the potential site or some other redevelopment costs that it might need to be incurred. For this discussion, that request or that gap that we verified by looking at their pro forma is $285,000. Let's also assume that a city is considering this request and has no other existing tax abatement obligations that might otherwise hinder its annual 10% limit on abatement. What's different with the abatement setup, we still need to have a thorough understanding of the project, identify the parcel information, and do all of the tax calculations that are needed for tax increment financing. However, we do not need to establish the map necessarily for the project that Rebecca alluded to. There is no project area that is adopted within the findings. However, in this instance, we may need to coordinate directly with the other county and school district if they are required to participate in order to overcome the gap in financing. So that advanced communication to reach out to those other jurisdictions and coordinate and deliver an understanding of the project need, whether or not that meets their criteria for their strategic goals to bring this new housing project forward, will need to happen in advance, whether you need their assistance as part of this tool. As I mentioned, all of the tax analysis that we developed for this project is identical for the project. It will pay the same amount of taxes as any other like property within the community. So all of that is the same, but let's zoom in now to see what's different with abatement. In this case, the slide segregates the annual tax revenue derived from the increase in value between the city's tax rate, the county's tax rate, and let's assume the school district is not going to participate, just like our prior slide when talking about abatement. So none of their revenue will be utilized to assist in overcoming this gap. So if we combine those two cash flows and understand that revenue stream over time, we see that we're able to hit our target of $285,000 by combining both the city's abatement with the county's abatement, and both of those combined can overcome the gap to bring this project forward. When the determination is made to move ahead and establish the abatement, there is a public hearing requirement. That hearing requires a notice that is published within the general paper of each of the entities that are going to grant the abatement. They are separate hearings and separate notices that need to go out. On that notice, the specific properties that are going to be abated, they need to be identified by their parcel identifier or other description, and the estimated total amount that is going to be granted or utilized under the abatement needs to be disclosed. When it comes time for the public hearing, both entities, in this instance, the city and the county, need to hold separate public hearings where they can hear from their constituencies and answer and address any questions that are raised on the project. Once they close those public hearings, they need to consider adopting the abatement in the form of an abatement resolution. That resolution will set forward the terms to be identified for the abatement, the length of time that those abated taxes will be collected. It needs to identify that there is a benefit to the public jurisdiction, the city and the county, that at least equals the amount of costs proposed within the agreement with the housing developer. And it needs to identify that under Chapter 469 in the establishing statute, that the abatement is in the public interest for any of one identified purpose. We list these on this next slide. The abatement only needs to meet one of these criteria, but it does need to be identified within the resolution. It needs to either, the project should increase or preserve the local tax base, provide employment or new employment opportunities, help acquire or construct public facilities. As we mentioned, abatement can be utilized to help finance public facilities. It can redevelop or renew blighted areas, provide access to new services within the community, perhaps tied to those public facilities, be used to finance public infrastructure, or to be used to stabilize the existing tax base. Now that concludes our presentation portion of our discussion. Let's hand it back to Jessica to see if any new questions have come in over this time.
Thanks, Nick. We do have some questions that have come in. And so the first one has to do with the term of the TIF district. If you have a 26-year TIF district and there is no longer any development activity in that district, can you decertify the district early? And Rebecca, why don't you take that one?
Thank you. Yes, absolutely. At the time when obligations are paid off, not only can you, but you need to decertify the district early. So as we look at those maximum terms for tax increment, they really are the statutory maximums. And we do typically set up the TIF district or the TIF plan under assuming those statutory maximums. However, at any point, you can limit them down when the district is being established. And as I mentioned, after the obligations are paid, you are required to decertify them, even if you have not gone for that full term of, in the case of a housing district, 26 years. We view that usually as a win-win, that we get the project done, but it is a benefit that it can get back on the tax rolls at full value earlier than anticipated.
Thanks, Rebecca. Our next question has to do with the notes that you talked about for the developer. And so the question is, do your clients typically add any credit enhancement or geo pledge on top of the pledge of TIF revenues? And Nick, do you want to take this one?
Sure, thank you. That's a great question. Typically, the community is going to have an understanding of what type of risk it wants to undertake in bringing this project forward. I would say that the majority of the time when issuing a TIF note, otherwise known as a pay-as-you-go note, the idea is to try to limit the amount of financial risk that can be incurred by the city, and so that you're limiting the assistance to only the increment or that revenue stream that's generated specifically from this project. However, nothing within the statute actually limits your jurisdiction's ability to contribute or pledge other resources to help bring that project forward. So there is an opportunity at the onset, and if needed under the but-for test, that a community could pledge its full backing of that project. Typically, that would come in the form of a bond that's issued to pay for those gap costs. That bond can be a general obligation bond that carries with it the ability to levy general taxes from the entire tax base and contribute those resources to pay back that bond. However, this does incur risk on the local jurisdiction, and so you should have your eyes wide open and understand that you would be, in that instance, perhaps pledging assistance beyond the tax increment.
Thanks, Nick. This next question I'll send to both of you based on your respective experience. And there are a series of questions about what's happening in communities in terms of how much TIF is being allocated to projects. And so this question is, how much TIF do you see being requested in current projects that need public finance? Is there a typical range for a commercial project or a housing project? And of course, the range of TIF is going to just depend on the value of the project and the size of the project. So maybe if you could talk about this in terms of what you're seeing in terms of the number of years of assistance potentially.
You know, I'll step in on this one, Jessica. It really varies quite a bit. And I should echo that when considering a request for public assistance, it is essential that the community have a firm understanding of the gap in financing for that project. Go ahead and scrutinize the developer's numbers, understand where that gap is coming from in terms of whether it's a restricted rent due to affordability criteria in a housing project, if it's market driven, that the market itself cannot afford the rents necessary to pay back the investment for this expensive project. Whatever that case may be, have a very firm understanding of that at the onset so that you can, again, verify that but-for test. But to directly address the question, again, it does vary, but it is not uncommon for us to see requests in the realm of something like 10% of the overall development cost. It is going to be project by project. That is not a firm number or firm percentage by any means, but that is a fairly consistent value that we've seen over time in the past. Depending on what type of project you're talking about, that could be a larger figure, especially when you're talking about speculative development, you know, outside of housing. New commercial office redevelopment right now is fairly constrained, very uncertain. And so we are seeing gaps much larger in those segments of development. And, you know, Rebecca, I'd be interested to hear your thoughts on this as well.
I would agree with everything you said on that. I think just going maybe one step further. The other thing to remember is that, like with an economic development district, so if you are doing office or warehouse distribution, manufacturing type projects, with an economic development district, your maximum term is 9 years of increment. And I would say that because of that shorter term, still scrutinize the project, look to determine that gap. But in those cases, you may be in a situation where you are looking at having a district that goes for that full term. However, on the flip side, if you are looking at maybe a smaller redevelopment project or an affordable housing project, because those terms for the TIF could go out to 26 years, as you look at scrutinizing the pro forma, determining that gap, you may not have as much of a need to go for that full 26 years. But again, as Nick said, it really comes down to a project by project review and understanding what that gap is and what the need is.
There's a follow-up question about what we're seeing in the market, and that has to do with, have there been any changes related to COVID-19? Are developers asking for more TIF, or are more developers asking for TIF as a result of the pandemic?
I will I have a very recent example on this. I'm not sure that I can say that COVID has changed the request for TIF. Generally, I think that we are still seeing a lot of, I know I have seen a lot of housing projects still looking to move forward. I think the challenge is that the construction cost is going up. So that is causing some challenges in their numbers, their pro formas. I had a project actually just last week where we had a discussion that the developer came forward and said, wow, from the time that we got our agreement in place to where we are now, my costs are significantly increasing. You know, can we have a discussion on what we can do because my pro forma has significantly changed? I will say that's not a request I have seen frequently. I think that it's probably a challenge that all projects are running into right now, and whether we tie that directly to COVID, I'm not sure if there's a direct connection, but I will say that project costs are expensive right now, and that is causing some challenges as we look at pro formas and construction costs. I don't know, Nick, you might have some additional experiences to add to that.
You know, as far as a tangible change, no, but I would say that there's definitely some uncertainty in the marketplace, especially for, you know, commercial projects. You know, there's a lot of vacancy within sites right now. So there is some turnover that's happening within the marketplace, and developers are you know, dealing with that. They're aware of it. They're watching, you know, a project that may have been thought that a brand new build seemed better than using an existing site. They might be changing their mind at this stage in the game. Places are looking to downsize their space. So there is a lot of turnover that's happening, and that's part of the game. That's part of understanding real estate markets. But as far as costs or public assistance requests, you know, the main change that I would see from COVID is exactly what Rebecca is describing. Commodity prices are changing. The cost of construction is going up. Whether that'll be temporary, you know, is anyone's guess, but it certainly is coming forward right now.
Thanks, Nick. So here's a question about what are the risks and costs of tax increment financing districts? And can you speak to examples of how land trusts have worked with TIF, if you have any? Nick, go ahead.
Thank you.
You're welcome.
So we have, you know, identified, you know, risk in the TIF district really depends on how you're utilizing this tool. I actually had a very salient conversation with the community last night, actually, about whether or not they had too many TIF districts within their community. Was there some magic number for when, you know, too much of your tax base or your potential tax base is tied up within existing TIF districts? And I don't have a firm restriction that I can tell you. We've actually looked at a variety of communities across the state, and you can look at them in terms of the overall size of their tax base, how many, you know, their population is. Their ability to fund really depends on the vibrancy of that community and your overall growth in your tax base. And this is a tool that helps establish that. You know, when you think not just of the time that the property is in the TIF district, but really the long-term benefits of actually having this new development within your community that you can rely on growing your tax base 20 to 50 to, you know, 75 years. That's where the real benefit is derived. So there are definitely, you know, some trade-offs involved. You are deferring the benefit of that new value in your community. There's certainly more risk involved if you're actually contributing other resources like your existing fund balance or issuing bonds on behalf of the project. That would up the level of risk. At that point in time, you're actually part of the risk of the development. That development needs to you know, continue to generate those revenues so that you're not backstopping and filling in that gap with your own levies. So it can vary, and those are things that you need to pay attention to. And we actually have some other discussions later on as part of this overall series of seminars webinars to discuss these very topics. Next part of the question was about land trusts.
Land trusts.
Yeah,
land
correct.
trusts. Yes.
Land trusts. So you know, tax increment itself can be utilized for property acquisition. So it can be a means to repay a obligation to acquire land, whether that's from a developer paying for the site up front, and you're using that revenue stream to reimburse perhaps what was a very high land cost or a cost that can't be overcome privately. On the flip side, it can also repay a public entity stepping forward to acquire that property and put it into a land trust, or even just to be sold to a developer. So in that instance, it can be utilized for reimbursing or offsetting a portion of that acquisition cost. And so that is definitely one of the avenues that you can consider for these housing needs.
All right, we have about 5 minutes left, and we have more questions than we have time for without people's names attached to those questions. So if I don't get to your question, if you would please contact us, we'd be happy to answer them for you. So the last question is, how do you allay general fears around TIF? I'm working with some county city staff who don't know much about it, but have heard horror stories from other communities. And Rebecca?
I will start that. I think that one of the challenges with TIF is getting people who are not comfortable or may not have used it before to really be comfortable and understand that while I know many people may have a horror story out there, the number of examples of how it can be a positive tool in the community, in my opinion, far outweigh the horror stories that we have. I think there's just a lot of misinformation out there about TIF. And so I think one of the, it sounds cliche, but one of the best ways is to really continue to have those lines of communication open, offer some workshops or training. Nick and I and Jessica spend a lot of time working with councils or public meetings where we just walk through, explain how TIF works and answer questions and concerns. But I think it really is having that education to your council, your EDAs, your HRAs, and the public on how TIF can be used, what you as a community are doing to, again, going back to Nick's comments about reviewing pro formas, scrutinizing the developer's numbers so that we do have confidence that if we are using TIF to fill a gap, we're not just throwing money at the developer to make them rich. And having these conversations in a perfect world as we move forward with considering projects, not necessarily when we have that exact project in hand, because it's always more difficult to educate and get people comfortable when there's a deadline and a project sitting right there that we're looking at. But if it's a tool you're looking at moving forward with, starting those discussions and starting that education process sooner than later.
Thanks, Rebecca.
If I could just jump in very quickly. So as Rebecca mentioned, pro forma, right at the onset, have a very robust process for reviewing that assistance application. Use a third party if you need to. We're certainly able to step in and provide our perspectives. You can do it within your own local community as well, but be able to defend that gap really does truly exist. I think when majority of conversations that I've been a part of, when we actually talk through that gap, why it exists, what limitations are in place, 90% of the questions go away. There's an understanding or a head nod that yes, this is not going to happen on its own within the marketplace. Even though a project just went forward, last year that seems somewhat similar, there might be challenges on this site that induce additional costs, restrictions within rents, things of that like. I think that's very important. And then, hopefully you're able to provide some information about how tax increment actually works, what the mechanics are. The majority of questions that I see in public hearings are, you're just relieving these developers of paying any taxes. Well, that's not actually the case. That property needs to pay taxes in order to generate the revenue to assist these projects. And it all comes through a public entity. It's held by the authority first and foremost before it gets paid out. So I think going through that and understanding that you are in control, you can establish a contract or a development agreement that puts restrictions on how this tool is used. That will alleviate most of those fears.
So that's all we
Rebecca?
have for you today. Thank you. I want to thank Nick for his insights and Jessica for helping us field all of your great questions. Thanks to all of you for taking time out of your busy day to join us. Note that a copy of today's presentation and a recording of the session will be posted on the virtual attendee hub for future reference and use. And because we're always interested in learning about the ways we can make your virtual experience more dynamic and deliver content that is most valuable to you, we'll be sending you a very brief survey in the upcoming days. We do hope you'll take time to give us your thoughts on what we did well and what we can do better. If your question was not answered, as Jessica said, we do encourage you to reach out to us. Thank you again for attending. Enjoy the rest of your day.
Thank you.